going to go through some information on life insurance policy loans because we get questions here. What we're primarily going to focus on are the interest rates with different companies, because that question comes up quite a bit. What is Mass Mutual's interest rate? What is Guardian's interest rate? New York Life? And there are different catches or pieces we want to be aware of, familiar with, before we use these policies. A couple other bullet points here is the accumulation. Just to reiterate, is that all life insurance policy loans, the interest accrues at what's called annual simple interest. Right? What that means is if I take a loan out, say of $10,000, right? Say my loan interest rate is 5%. What's 5% of 10,000? $500. How that will actually accrue, if I look at my life insurance policy, my loan statement, my loan balance on my online account, is that $500, you want to divide that by 365 days. Right, so I think it comes out to like $1.87 or something like that. If you actually break it up, that's how much interest accrual you would see tack on to your balance at the end of each day. And at the total of 365 days, you would see $500. So if we pay any of that down over the course of the year, guess what? We obviously pay less interest. And the payments, while those are optional, we have other videos and content on that, so we're not going to go into detail on this piece. What we're going to focus on here really are the four major mutual companies and the loan interest rates, how they work, because you've got some options here. So to begin, we've got our four major mutual companies listed here with their type as well. When I say type of company, I mean non-direct recognition or direct recognition, which we've got videos on that. So the first thing we're going to go through, our first company, is Mass Mutual, right, which has a dividend rate of 6.4% and a variable loan rate of 5%. Let's touch on that first. Let's do this actually. All right, so if we've got Mass Mutual, dividend rate is 6.4%. Again, they have a variable loan rate of 5%. Let's touch on this first and foremost. That variable loan rate has a floor of 5%. The lowest it can go is 5%. It's been there for several years, about 5 years plus now. So 5% floor. What determines that loan interest rate? Because we've got the word variable in there. It can go up and down. Is what Mass Mutual uses as a gauge to determine what their loan rate is Moody's Corporate Bond Index. That's a AAA rated bond, corporate bond. It's been under 5% for a long time because Mass Mutual's floor is 5%. That's why we're not lower than 5%. Now, if interest rates go up, right, that's the big thing we want to be aware of, right? If I've got a policy with Mass Mutual and interest rates go up, I've got a variable loan rate. So what does that mean? How is it going to impact my cost of borrowing? So as a policyholder, again, I've got the variable loan rate here. As a company, right? So this is Mass Mutual as a company. Moody's Corporate Bond Index can adjust how often? Daily. So that 5% loan rate for Mass Mutual as a company can adjust daily. As a policyholder, let's put this in blue. Got a difference here. Right? How this works is I do have a protection. Is that my variable loan rate cannot increase by more than 0.5% per year. For example, Mass Mutual's variable loan rate today is 5%. Say next year, the interest rate by the company is 8%, right? Things jump up, hypothetically. As a policyholder, my new loan rate would have gone from 5 to 5.5%. Even though the company jumps to 8%. So I have a cap on how much I can increase per year. It can never go up by more than 0.5%. On the flip side, if my rate creeps up to 8% over a certain period of time and interest rates plummet, what will happen is there's no cap on how much I can drop, with the exception being the floor of 5%. Does that make sense? Cool. So that is MassMutual's variable loan rate. And if I elect the variable loan rate, the policy is non-direct recognition, which means I'm going to receive that 6.4% dividend on any money still in cash and any money that I have loaned out. Money's going to stay at work for me the whole time. They also have here an option of a fixed loan rate, which we rarely select with MassMutual. Right? So a fixed loan rate, which is at 6%. This does turn the policy into a direct recognition account, which simply means they're going to recognize the fact that we have a loan outstanding. I'm still going to earn dividends on my entire bucket of money. However, the borrowed portion will receive a dividend rate that may be different than the company's standard dividend rate. So MassMutual has historically adjusted the dividend rate to a rate lower than my cost of borrowing. So if I have a fixed percent loan rate at 6% and I borrow, I'm still receiving dividends. Right? Historically, we've seen it around 5.5%, lower than what I'm paying. Right now, it's actually higher. It's a rate greater than 6%. But the thing is, we're leaving that in MassMutual's hands, right? The insurance company's control instead of ours. So typically, when we're looking at Mass, usually we're going with a variable loan rate, especially due to the fact that the dividend rate has been higher, anywhere from 1 to 1.5 points higher than the loan rate. Dividend rate on average has been higher than the loan rate. Let's progress on. Oops. Next, we've got New York Life. So they function very comparable to MassMutual in the sense that they have a variable loan rate only, and it functions in the same manner in the sense that it is linked to Moody's Corporate Bond Index. The floor is 5%. No need to go into detail there. Guardian. Right, so we've got the direct recognition factor. We've touched on in prior videos that they actually increase our dividend rate when we borrow, right, on borrowed funds. We're not going to go into that here, even though this example spells it out for us. What we're going to touch on is their different loan rates and exactly how that works. All right, so good old Guardian. Dividend rate. Presently, 5.85%. I can also elect that indexing strategy, which is with a whole life feature, and I can switch back and forth. Okay, that's nice. Here's the main thing. So I have a fixed loan rate of 6%. And to clarify here, if I borrow from my cash value, any money that's still in cash gets the basic dividend rate. Any funds that are borrowed, they're direct recognition, they are adjusting my dividend rate and they're paying me a 6% rate on borrowed funds. Now, here's the other pieces you've got here. At the year 10 mark, this is the 10th year of the policy, I can elect to switch my loan rate to variable, which is linked to Moody's Corporate Bond Index, functions exactly the same as MassMutual, with the difference that the floor is 4.5% instead of 5%. A little bit lower floor. What's also important to note here is that if I make this change, my Guardian policy now functions in a non-direct recognition manner. Meaning regardless of what my loan rate is, what my loan balance is, I'm still getting the basic dividend or index crediting on everything, my entire bucket of money. Ready for phase 3? 1, 2, 3. At age 65, right? Or typically 20 years. The 10 pay, it's 10 years, but just look at this for now. So it's at the later of age 65 or 20 years into the policy. If I've kept the fixed loan rate option, I now have a fixed loan rate of 4%. They drop it down to 4%. Right? Why they do this is to increase the ability to pull out income. A lot of times these products are positioned for retirement income, right? Not so much the banking concept, which has to do with borrowing and repaying, using it like a line of credit. This is when I'm done, when I'm retired, I just want to take an income stream out of this thing, right? Almost create my own pension in a sense. What a lot of these companies do. This is the exact same thing here. Why Guardian has this is really just a competitive edge they use. All companies have different competitive edges, but this is a means to allow a policyholder to pull out more income, especially on a guaranteed basis. So step 1, or phase 1, I've got a fixed loan rate with a Guardian policy at 6%. Step 2, I can elect that variable loan rate option. I do not have to. I can keep the fixed one if I want to. And then step 3, my fixed loan rate will drop to 4%. Questions on that? All right. Let's progress on. One more to go. Northwestern Mutual, right, which is direct recognition. Current dividend rate 5%, fixed loan rate of 8%. On paper, sounds horrible. It's actually not that horrible. They do something to help their policyholders. Similar to Guardian, not the same, but it is similar. Right, so we've got Northwestern. Present dividend rate, 5% flat. Fixed loan rate, of 8%. All right, again on paper, that's a 3% spread. Like, why would I borrow? I wouldn't if I was not educated, right? That's what I want to know here. So if I borrow funds from the account, what happens? Let's say I take out a loan of $50,000, right? What's going to happen is obviously I've got a cost of borrowing of what? 8%. If all things are equal, or if it's a non-direct recognition company, what that would mean is that Northwestern is still going to credit me that 5% dividend on the borrowed funds while I pay 8%. Doesn't make sense. Here's what they do. So I still get a dividend. I'm going to put this in pinkish purple. On my loan balance. It is not 5%. That 5% is still credited to any money that's still in cash value, non-borrowed. Run out of space. All right, there we go. Right, so how this works is Northwestern, for the first 20 years, will adjust my loan rate, my dividend rate to 7%. Right, they do this so I do not feel like I'm being punished from taking out a loan with a negative 3% spread. I still have a negative spread, right? My cost is 8%, dividend rate is 7%. But what you will see is if I borrow, then repay, compared to just letting it sit and grow, I'm going to have more money in the example when I borrowed and repaid it because I received an enhanced, a higher dividend rate on those borrowed funds. Right, so that's for the first 20 years, and then at the 21-year mark, from that point forward, my dividend rate on borrowed funds is 7.75%. They increase it further. Right, so they're increasing the loan rate the dividend rate on borrowed funds, again, so consumers don't feel like they're going to be punished. Now, when you look at the big four, right, who's the best from a cost of borrowing standpoint? Which ones do we use the most? MassMutual and Guardian. New York Life works well for this as well. Obviously, we can't use Northwestern just with their structure. We have to be an exclusive agent for them, but their policies work, right? If we've got an account through them, historically they have been sound. They've always delivered. All right, so there are some loan features, loan rates and such on the big four. I hope you found this helpful. Let us know if you have questions.